Traders at Axis Bank say they expect an increase in bond yields due to reduced system liquidity. Adamma Mbachu, team lead, currency trading at Axis Bank, joins me for a midweek market review. Adamma, thank you for taking the time out to join us today.
Thank you, Esther, and thank you for having me.
Great. Now let's get right to it. Let's start with today's overall market performance so far. Bring us up to speed on what you're seeing so far.
Okay, so I'll start with the market liquidity. We opened with a balance of about 69 billion, which is actually positive, and it's the first time it has been positive over the past few days. And then we saw the overnight rates trading at 16.5% levels, and we expect little or no activity in the treasury bill space as the market participants have been on the sidelines. However, there was an OMO maturity of 25 billion that came into the system this week. We also saw a special bill maturity that also came into the system, and I think that is what has boosted the liquidity in the market. Moving into the bond space, like you said, the bonds have been a bit of sell-off in the bond space, and then we saw the 5-year and the 7-year maturities trading at 14.75 and 16.75% respectively. We saw more interest in the longer tenor space in the fixed income bond market, to be precise. Going into the foreign currency market, we have seen persistent illiquidity in that market. We saw the I&E trading at 445 levels. However, CBN has actually sustained interventions in that space, the retail interventions and the SME and invisible interventions.
So what is investment playbook for investors at this time? We're seeing bond yields increasing. We know the government will continue to borrow. System liquidity, it's in and out, oscillates from day to day or week to week. But how are investors playing the market? What is the investing psyche at this time?
Oh, fine. The sentiments of investors actually, the investors actually look at the market and they watch the market. They consider the risk versus the return on investment in that space. They also consider what policies are coming up to improve the market activities. So for us, when they see yields going up, investors actually selling down most of their portfolios to, like you said, to raise liquidity or improve liquidity in that space. However, some investors or some market participants will take it as use it as an opportunity to actually cash into that space and take profit and then go on the other side. So we see mixed sentiment playing out in the market.
Now, if we could take our minds back to the beginning of the year and the forecasts that were made for how the market was going to perform this year, would you say that it's performed in line with what the forecasts were, or we did see more traction, more activities, or are yields at where the forecast had predicted that they would be at this time of the year?
Oh, well, for the market, actually, the forecast for us in the market, although we saw a bit of shocks in the market, which was actually they deviated from what the forecast was saying. However, we saw a bit of adjustment. Like I said, the market trades with sentiment, in the market. The market participants actually trade along with sentiment. Even though most of you have seen increase in inflation, which has been a major factor, we have seen that the MPR rate has been increased, back to back over the year, and which has been expected given what is happening in the global economy. So I can say yes, the market at least 80% was in line with the forecast, and while we had to deal with the shocks and adjustments.
Could you say the same for the corporate bond market? How would you describe the corporates this year? I mean, last year was a good year. We had a number of commercial papers, of course, when rates were lower then or yields were lower, but it's a different story now.
Oh yes, for the corporate bonds, we have seen traction in the market space. Most corporate organizations have actually been able to sell or to push the sale of most of their corporate bonds in the market, to drive liquidity and also to create more diversified portfolio. But however, what the market is actually checking is actually the risk around such investors compared to what they see on the sovereign bonds. So we have seen a bit of comparison check across those bonds, but in as much the market has actually been active on both spaces.